I hope you're having a great Monday. So let's talk about Bitcoin. We've had a lot of action in the last week for Bitcoin. In fact, we've had a lot of action for the last 11 days. Bitcoin has been on a tear. So what is going on with Bitcoin and what can we expect as we move forward in the future here? So one thing I always like to take a look at is I like to take a look at the overall cryptocurrency market and sort by gains and losses. And it's interesting to see what's up and down day to day and look at the price action in the charts on specific days at specific times. And I've showed you where some of that kind of lines up, but it's starting to change a little bit here lately as Bitcoin is kind of bouncing around. It's starting to separate itself from the pack in terms of price action, and especially Ethereum. So let's go ahead and go over to the chart here real quick. Here's the Bitcoin chart. After 11 straight up days, now we have 3 down days and we're working on our 3rd down day. Ethereum is on the run that Bitcoin was just on. So Bitcoin is leading Ethereum. And then once Ethereum finishes making its move, then we can look for large cap altcoins to be making a move. Some of them are making a move right now. Some of them are following right along with Bitcoin. Some of them are lagging a little bit. So it's just interesting to watch how it kind of revolves and how it's moving around. So let's take a look at Bitcoin and kind of talk about what can we expect from Bitcoin. So overall, I talk a lot about trends. I'm not a technical analyst. I'm not a chartist. I am a opportunistic investor. I invest with trends, big swing moves, like lows to highs, things like that, momentum trades, and I respect the trend in the market and the momentum in the market as we go up and as we go down. And overall, even with an 11-day up, we are still in a downtrend overall in the market, because even though we came up quite a bit to that 42.3 level, that is still a lower high until we get really above 50,000. So anything up to 50,000 is just another lower high. Now that's good in terms of movement back towards that that breaking out and reversing the trend. But a lot of people have asked me, what constitutes reversal of trend? And a reversal of trend is higher highs and higher lows versus lower highs and lower lows. So right now we still have our lower low down here at 29,000, and we've got our lower high at that 42,000. So the next higher high, in order to really reverse the trend and put in that higher trend reversal back towards 65,000 and maybe even all-time highs, is we have to close above 50,000 and we have to put in higher lows in order to confirm reversal of that trend. And really what you want to see is, like right now, we're at that 42.2 for the last lower high. So what you really want to see is you want to see closing back above 42.2 with a low closing, with a low closing, and then reversing with a higher low put in above 42.2. So we could close right here and then turn around and reverse, like we're at 38,780 right now, 38,000. If we closed right there for the day and then reversed upwards and then closed above 42, now you have a higher low in place and a higher high, or a lower, you still have a lower high but a higher low until we move our way back above that 50,000 range. And then we can get back into higher highs and higher lows. And really what it's all about, identifying and trading these trends, is when you're in an up market, you're spiking up and then you drop. You spike up and then you drop. But as long as you have higher highs and higher lows along the way, higher highs and higher lows along the way, you know that you're in an uptrend, higher highs, higher lows. And a lot of people know that. But remember, in a up market, price spikes up and then it drops. It spikes up to a higher high and it drops to a higher low, spikes up again to a higher high and higher low. When you're in a down market, in a downtrend, price drops. Right here, we put in our first lower low or higher low, or lower low below these last lows here. And then you get your lower high right here. So now you have a lower low and a lower high. So price drops and then it spikes, and then price drops and then it spikes, and then price drops and then it spikes, to where you're putting in lower highs and lower lows all the way down through that trend. So in order to reverse that, you have to break out of that and you have to start putting in higher highs and higher lows above the last lower highs and lower lows in order to reverse that trend. So that's really what we're looking at overall. Until we do that, we can't call a trend reversal. Now, the other question that is on a lot of people's mind is, again, this is that range that we've been talking about, that $30,000 to $40,000 range. And this was a great trade of liquidity right here from 28, 29,000 back up to 42. And if you traded that, I mean, that's a 30% move right there in the matter of a couple of weeks. Huge liquidity range right here. So we could sit here and range in this 37, 38 to 40,000 range for a while, kind of like we were doing over here where we started out for several months before we dipped down and the range tightened, and then we dipped down again before this bounce. And if you look at the price action, I'm on a daily here, we're basically retracing our steps everywhere we've been. So every time we have a drop, we get a bounce, then we drop, we get a bounce, and we're kind of recapturing these drops and these bounces all along the way. And we've had this drop here that we recaptured over here. So we could potentially drop and then recapture that. But what we want, again, is we want to close above this last high that we put in. We want to close a low and then go close above that last high that we put in. Then you can start looking for a trend reversal, especially if we start closing lows above this last high. Then we have higher lows and we have higher highs, moving our way back up the mountain again. Spike up, drop, spike up, drop. That's kind of what we're looking for in terms of reversing the trend and getting back to all-time highs. The real question is, how long is that going to take? When is it going to happen? And if we continue down and we test this lower range again in that $30,000 range, can we break through that? And can we go lower? And if we go lower, how low can we go? And that's the real question that nobody really knows the answer to. And there's no way to know until we get there, is how low can the market really go? So you have broader scale adoption, you have more institutions getting into the game. I've been bringing on institutional investors and interviewing them and talking to them about Bitcoin, cryptocurrencies, and the market as a whole. And one of the things that that we see going on right now, we'll go back to sharing the screen here. And if you look at the financial markets right now, we had a little bit of a taper, and the big question in the stock markets is, how long can the record gains in the stock market last? And as the economy hits its peak in all areas, financial markets, real estate, pretty much production, as we get back to work and we get everything back open again, and we get on the other side of this whole COVID thing, how much further can the real traditional markets really go? How much higher can they really go? And what happens when they hit their peak, and where does the money go? Well, Wall Street's positioning itself to get into the crypto space because that's where yield is now. There's no longer yield in the stock markets. They're reaching diminishing returns there to where it no longer makes any sense. And the gains are going to be minimal exponentially. So that's why they're moving into the crypto space, because it's an inefficient market, meaning there's a lot of exchanges, a lot of areas to capture, as you heard my interview the other day, price action across exchanges, price action across assets. That's why you see similar price action with a lot of these assets across the board. So they can get in, get out, they can do high frequency trading, they can do market inefficiencies, they can do all kinds of different ways to take advantage of these crypto markets. So that's why Wall Street's moving into the space. They want exposure to the price action, and they want to be able to work these inefficient markets. But as more people get involved, as more money enters the market, it will become more efficient, and the big volatility moves that we're seeing will settle down a little bit. But right now, these are huge ranges for institutions to be trading in. So it's very enticing and very exciting. So back to the question of how low can the market really go? Once we get down to that 30,000 level, we'll just have to see what all's involved, but it may very well be that the bottom was put in there. It could potentially go lower down to the 20,000 range, down to the 10,000 range. Some analysts have called for that. And whether or not that's possible now with the number of entities that are getting involved from an institutional perspective, broad scale adoption, the retail public as a whole, still very small in terms of user base compared to what the potential is. And as more awareness is brought to the markets, as more stability is brought to the markets, more people will enter. So that could potentially put that floor in around that 29, 28, 25 to 30,000 range. We could potentially find a floor there that we will go back and retest it again here at some point after this recent move that we had. And if that holds, that very well could be the last chance or the last test of that region. And we could be off to new all-time highs from there and start to see that $100,000 range and kind of test that, find out what the appetite for Bitcoin is at that price level. So we won't know till we get there. Right now, we haven't been able to get above that 40,000 level significantly. I mean, I know we spiked here and there in that 40,000 plus or minus range to maybe 42. Let's take a look at that again real quick and see what this is in terms of where we landed. Recently, I think we had a spike up to, 42.6. There was a spike, and then a couple other spikes in that 42.4. And you could potentially see mid 40s up to that 50,000 range. And again, that's your next big test is 50,000. We really got to get above 50,000 and start closing above that with highs and lows in order to really reverse the trend. And anything up until that point can be considered a trap. It can be considered a test along the way. And that's, again, another big range, which we could very well step up into that to where we're trading instead of 30 to 40, the next step could be 40 to 50. So anything can happen. We could get stuck in these ranges for a while. It's a huge liquidity, but the real question is, have we put a bottom in here? And is there a potential that it could go down? And that we don't know until we get there and retest that again. And a lot of it's going to depend on the regulatory environment, all the things that are going on, institutional adoption, and how far that could potentially go at that point. So it could be that 29,000 is about as low as it's going to go for the foreseeable future. So until we get there, we won't know. Nobody knows. The economists don't know. Investors, traders don't know. Nobody knows until we get there. All we know is right now we've got 50,000 we need to get to and above as a ceiling at this moment. Really 40,000 is kind of holding us back. But really once you get across that, 50,000 is your next level. 30,000 is the floor that's been put in. We have to retest that again to see if that was real and if we can move on from there. So if we get down there again, test it and hold it, that's the point of entry. And that's where we could potentially be off to new all-time highs. But like I said, there are a lot of people out there, a lot of very talented technical analysts and traders that think that we could go well below that and then enter into a bear market. So we'll just have to see what happens and which way things go once we get there. All we can do is wait and trade the action that's in front of us right now. And, like I said, you always want to hope for the best, but plan for the worst. You always want to accurately calculate the risk, assess that risk, and be able to not only understand it, but withstand it if and when that risk comes in. You want to set your stops and your limits so that you can protect yourself. If you buy, make sure you set a stop so that you're not losing money in case something changes, the market switches on you, things like that. It's a 24/7 market. It's still volatile. Institutions are not in at broad scale yet. They're setting up, they're getting ready, but we could be 6 months to a year away before you get real broad scale institutional adoption where they can really commit 1, 2, 3, 5% of their assets into the market, which is significant when you start adding up these institutions across the board that want to get involved. So that's something to keep an eye on, be prepared for. And that's what this all could be about. This could all be setting the table, keeping the market propped up until the institutions can really get involved and drive that price action up. So that's one of the things I'm looking at. I'll talk more about that as we go along. And you see the people that I'm talking to that are institutional investors, investment bankers, and hedge fund managers in terms of what's going on with price action right now. There is a thesis out there that the table could just be getting set and kind of keeping price action at a level until more institutions can get involved in the markets to really drive it to the next level. So we'll see if that's true. Nobody really knows until we get there. All we can do is trade what's in front of us, respect the trend that's in front of us until the trend changes and is reversed. We have to expect the trend to continue in the direction that we're in right now until otherwise confirmed. So hope for the best, plan for the worst. The trend is your friend.